Very good afternoon to everyone who's been able to join us so far. And thank you for following us on our Centum Capital webinar series. This is the fourth series that we are holding so far. And we want to thank everyone for the attendance that we've been able to have. Today we have an interesting discussion on investment structuring, which is going to be led by our Ken Kamau. And we have our usual other panelists, Thomas Omondi, partner at Centum Capital, Wambua Kimeu, partner also at Centum Capital, and myself, managing partner. Ken Kamau is an investment manager with us in terms of introducing him to you. He has previously been Chief Finance Officer at Coms Africa. And before that, he was actually at Centum before he was seconded there. So he comes from a very strong operational background, but also an investment hat. So for today, and as usual, you are encouraged to send us questions, messages, or any inquiries using the chat function on the right-hand side of your screen. We will be sharing the presentation with all those who've registered, and you'll be able to keep interacting with us. And we'll also be having a recording of the material that was shared during this webinar. So with that, I would then now like to hand over to Kenneth Kamau to then take us through the material he has today on investment structuring. Welcome, Ken.
Just a second. Okay, thank you so much, Fred, for the introduction. Without taking too much time, I'll just dive right into it. We will look at first just a very brief overview of the current situation, and then we will delve into the impact of COVID-19 on risk appetite of the various players. Then we'll look at how to mitigate downside risk, and then we'll finish off with some investment structures that we can consider. So just speaking the context of Africa and Kenya in particular, there's trouble coming, although we have seen some improvement in the stock market and some pricing just edging upwards. But generally speaking, most African countries rely on export income, say coffee, tea, horticultural products. What COVID has done is to disrupt those supply and demand chains, which is affecting Africa's ability to generate earnings. Secondly, we know that African countries have a high level of debt to GDP. The average external debt to GDP of African countries is 54%. Kenya's is at 37%. So we're a little bit better off. But with that high level of external debt and with volatility of currencies that we're seeing now, it means that the cost of debt service will be expected to be higher because it will cost more to buy that hard currency to be able to service external debt. And with the health-mandated lockdowns and curfews that limit tourism, we expect that the forex flows that should deal with that situation will be muted. There has also been capital flight from emerging markets to developing economies, which has led to a decrease in asset prices of good companies, and this is evident in our stock markets. We expect the pressure on the economy to continue. Kenya is expected to grow at 1% this year, according to the World Bank. but the global economy is expected to contract by 3%. Just looking at Kenya specifically, the currency movement has really affected our macroeconomic position. It's been made worse by, of course, the capital flight, import bill versus export earnings. Although the import bill has been a little bit lower because of the lower oil prices, but still, it's something that that we have to grapple with. We've talked about the rising debt obligation in Kenya and in Africa generally, and again, this is because of the depreciating local currencies. It's costing more to service these external debts, when at the same time foreign income flows, foreign currency flows have grinded to a halt. And thirdly, we've seen the reduced consumption expenditure both by businesses and individuals as they choose to conserve cash and spend only on necessities, and just because of the uncertainty of what the future holds. Regionally, there's of course the border closures, the supply chain the disruptions which affect trade, and there's a political and election cycles coming up, starting this year with Tanzania, Uganda next year, and Kenya in 2022. But let's look at the impact of COVID-19 on risk appetite. So the global market volatility index tells us that the volatility in asset prices has been high, which signals high risk perception by investors. When you look at the MSCI World Index, we see at the around June, well, a little bit before that, it dipped. It's recovering slowly, which is indicative of capital flight from what is perceived to be risky assets like equities to safe haven securities like fixed income and gold. And on the chart here, we see that gold has been edging upwards, indicating demand because investors are just trying to conserve capital value in an environment where currency depreciation and volatility in asset prices is quite high. Again, on risk appetite, just looking at the Kenya Euro bonds, the 2018 issues, the two issues, the 30-year bond and 10-year bond. I'm looking at the chart on the top left. We see that the difference in yields was only 80 basis points. We look at the 8.6 minus the 7.8, and consider that these two bonds have a 20-year difference in maturity. That's a convergence between the long term and the short term. So because it's a signal of a high near term risk that these investors are perceiving. On the right hand side, we see for the 2019 bonds, the 12-year and the 7-year, that's a 5-year difference. There's a 40 basis point difference if you look at the 9.6 minus the 9.2. Again, just for the same reason. And on the Kenya yield curve, the difference between the 10-year and the 23-year bond is only 110 basis points. And of course, the thematic flattening of the yield curve is indicative of sort of a convergence between short-term and long-term rates, where the investors are demanding a higher risk premium to compensate for the near-term risk. Just moving on to the stock market, again, still on risk appetite. You can see then the chart on the top left, the NSE All Share Index, a dip at the end, but edging upwards slowly, which is good. But if you really want to see the pricing impact, just looking at the chart at the bottom, the P ratio is at 8.2 is the lowest it's been over the last 5 years, and that has it's again indicative of capital flight by investors, as well as asset price declines because of the expected impact of COVID-19. And on the right, we see that the dividend yield would obviously be higher as the prices decline. Again, just still on risk appetite. You see what's happening with the businesses that are struggling. I mean, they're facing falling demand and revenues. Input supplies are being interrupted because of the global supply chain disruption. There's been tightening of the credit conditions. There's no money, no access to capital. And there's just general increased uncertainty. And what businesses are doing now, and just referring to the last webinar we did, we talked about how businesses are shifting to cash conservation, expense management, asset liquidation, and where applicable, sort of moving from risky assets to fixed income and safer securities. But despite all that, providers of capital are still reeling from the effects of the investment that they have done in the past. Banks are now facing higher NPLs. There are higher values of restructured debt. As of the last report, 360 billion, which is a lot of money. So if you want to access credit, it will be at higher prices. For private investors, we've spoken about the sell-offs from equities and reallocation to cash and fixed income, a flight to precious metals, and just general capital flight from risky economies like emerging markets to developed markets. So there has been a lower risk appetite by capital providers. They are holding back just until they see the full effects of this COVID-19. Okay, thank you. But opportunities exist despite the risks. Just looking at this chart here, and I'm just I will pick up the pace here. This shows what happened in 2008, 2009 during the credit crisis, where valuations dropped from highs of 10 to just 6.5 within a period of about 6 months. But in subsequent periods, we see that it recovered really quickly. We believe that we are in that same situation right now, and that there is opportunity for investors that would like to ride the wave all the way to the high multiples that we've seen in the past. So how do we mitigate downside risk in this environment? Well, first we need to choose the industry and the sectors that we'd like to participate in. We'll talk a little bit more about where we feel money should really go. But once you have selected the industries you want to participate in, the businesses you choose must be fundamentally sound. They must be profitable. It sounds obvious, but yeah, I mean, they have to make money. But profitability must also be matched with cash generation. So one of the ways that a business can be profitable and not generate cash is if it has high working capital requirement or high capex requirement. So you want to be careful that the business that you're investing in, any capex that they want to invest in must be matched with a commensurate return on new invested capital, so that the investment is worthwhile and it's expected to give a return. and the business must have a well-defined competitive advantage to be able to compete with the players in the industry, and it must have it must not rely on just a small pool of customers. It must have a large pool of customers. We'll see examples of those types of businesses shortly. Now, and again, to mitigate this downside risk, you have to make sure that you do not overpay for the business. And in particular, you have to be careful about relying on multiples during this period. A proper valuation is, for example, a DCF model or economic profit model that incorporates scenario analysis that caters for every, well, at least most of the scenarios that are likely to occur and impact the business that you're targeting. You will also notice that sellers will prefer to use pre-COVID financial performance. Buyers, on the other hand, want to incorporate the full effects of COVID, which is why you should use an approach that looks at all the scenarios. Other ways to mitigate your downside risk is to make sure that you do not pay the full purchase price on day one, and this can become useful, especially where the target company shareholders want to get some type of cash out that can be tranched, paid over time, and tied to milestones. And lastly, if there's a disagreement in pricing, you can use a forward enterprise value to EBITDA multiple, where if the seller is promising a certain type of performance, then you can tie the price to that performance being achieved using a forward EV to EBITDA multiple. Other ways you can deal with downside risk is if there's a deal now that you're not so sure that you can go through with, is there a material adverse change clause in the documentation that can allow you to walk away and wait until the economy turns around? Or is there a financing out option that would allow you to walk away should you not be able to raise the funding that's needed to purchase the business? Now, so these are the three sectors that we believe will be winners and will offer attractive opportunities. Healthcare, not so much the hospitals, but on the equipment and diagnostic side, you can see that these are businesses that rely on a huge pool of customers. They don't rely on just one or two customers. Retail and supermarkets, those provide an essential service, and they've evolved their businesses to include last mile deliveries, telecoms and ISPs. We're using the internet more. We expect that to continue. So that should do well. And these sectors, we believe that if they adapt, they should be able to come out in stronger positions. So consumer goods and services, say for example F&B, they need to enhance customer experience, quickly understand customer changing preferences, and cut costs by redeploying staff. Financial services, we've talked about the challenges they're facing with their debt and the restructuring. They need to conserve liquidity, digitize processes to further reduce visits to the branches. That's how they adapt. Manufacturing, they need to adapt by cutting down on loans, leveraging, collecting receivables, make sure that they have cash in the business, and where possible, innovating and providing products that are required during this period. Education adapted pretty quickly. There's e-learning, so not much to say there. Agribusiness players need to find new routes to market and to end customers. Of course, we see that in this environment, imports of food will be a problem. So agribusiness will do well during this period, just depending on how long this environment lasts. And technology will do well if they adapt to provide products that are needed during this period. Lastly, to mitigate downside risk, you need to choose the right investment structure. For private equity, you're probably looking at equity or some sort of debt instrument. Well, we believe that equity investment should be preferred for, in businesses that are mature and cash generative. And we'll see a simulation of how this can work if equity investment, if an equity investment is made on a business that is struggling. The other instrument we will prefer, say if a company requires money to develop a product or for an expansion, is a mezzanine instrument. This is an instrument that lies between senior debt and equity generally, but it ranks higher than equity, and it may take many different forms: convertible debt, preference shares, subordinated debt with with warrants. And the good thing about this is that there are different ways that it can pay a return. For example, cash interest. But for a business that requires cash, they could pay the interest in kind. So payment in kind interest is just an accrual of interest so that it will be paid later when there's money available. Another payment would be a participation in payouts, for example, just a percentage of the profits or EBITDA, or it could even pay off in form of ownership. And frequently you'll find that they have a conversion option, which again helps with the upside. So we look at two simulations here. Just to explain these structures, we'll see the return to senior debt, we'll see the return to equity and to mezzanine in two different situations. The first one is in good times. Everyone will, is happy. This business right now, the EBITDA is growing at 30% year on year. We compute equity value. Just first we assume a EV/EBITDA multiple of 5. We get the enterprise value. We deduct the debt. We get the equity value. So we have a computation of value per share and dividend per share. Then the company invests, issues a mezzanine instrument that has a conversion price of 11, conversion ratio, which is the number of shares that the instrument would be exchanged for, is 18.18, and a coupon rate of 15%. So the conversion happens here in year 3 because the conversion price is achieved. So let's look at the return. So it's a 200 investment is 200. There's coupon and there's dividend after conversion. There's an IRR of 25% in good times. Equity return is 56% as expected. So they're smiling all the way to the bank. The senior lender is at 13%. That's all they get because that's the rate on the instrument that they have invested in or the loan that they've given. Let's look at the flip side. In bad times, what happens? Here we have a 50% decline in year 2 due to COVID, for example. Everything else the same. There's no conversion because the conversion price of 11 is never attained. Value per share doesn't even hit 3 here. The debt is at 13, mezzanine is at 15, just like before. Here, the mezzanine instrument limits the downside risk to 15%. The senior lender gets her 13%, but the equity holder is sort of wiped out at minus 38%. And just an application of what has happened in the real world. About a year ago, Berkshire Hathaway invested $10 billion USD in Occidental Petroleum, and they invested this as 8% preferential shares with warrants on condition that they acquired a company called Anadarko Petroleum. So 10 billion prefs that pay 8% per year. They could pay this dividend either in cash or in kind, as shares of equivalent value. 1 year later, this was 1 year ago, mid 2019. Now it's 1 year later. Oil prices have crashed. Occidental Petroleum shares have lost more than 70% of their value. And Berkshire Hathaway still receives the 8% dividend on their prefs, which is equivalent to 800 million annually. Come rain, come sunshine, they get their money. So that's That's downside risk protection. And that's all for now. Thank you so much.
Great. Kenneth, thank you very much for that presentation on investment structuring, and quite interesting insights coming through. Looking at businesses and how they get funded and the kind of return investors get. Looks like the senior lenders will always get their 13% return, come rain or shine, unless the business goes into liquidation. The mezzanine has downside risk protected and we get their 15%. And it's quite useful, the case you've given on Berkshire Hathaway, but even in the middle of an oil crash and the stocks of Occidental Petroleum coming down more than 70%, they are still getting their 8% pref, which is quite good. And the equity investor could either make 56% shooting out the lights or lose 38%. So quite an interesting array of different investment returns, depending on what instrument one is taking. So we have a couple of questions received, and we want to encourage the attendants to please continue putting your questions through. We're going to try and address as many of them as possible. Let me begin with some questions to you, Ambua. So two questions. One question is related to the COVID-19 risk and how are businesses limiting exposure to the risks that they are seeing during this COVID-19. And then the second question is then for businesses that are going through and trying to raise capital. How do you raise capital dealing with the uncertainties during this COVID-19 period?
Okay, thank you, Fred, for those questions. I'll start off with the first one. I believe the first one is on how businesses are limiting their exposure to COVID-19. So this is something we had covered in the last webinar we had. So basically, just looking at how do the businesses, what should businesses do? So one of the key things really, which is a critical bit, is around liquidity. So businesses need to look at how their revenues are coming in and what they're able to collect in terms of cash. But then on the other side, also they need to look at how they're spending money. So from our cash perspective, a liquidity perspective, then you minimize on your expenses. You make sure that you're pulling in as much cash that's coming in, whether it's from collecting receivables or on the other hand from your revenues. And then on the other hand is also just to make sure that the business, we keep the lights on and keep the business running. So basically it's just looking at the supply chain and making sure that if you're a manufacturing entity or a trading entity, that you're able to get your produce and where you're not, your raw material, and also on the other hand, make sure that you're able to reach the customer. So these are just basic practical things that we've seen businesses do. And at the same time, is just keep the communication lines open and maintain your relationships with your suppliers and your customers, so that then you can get through this. But just to look at, I think one key area which is important, and I'll just go back to my first point, which was cash. With cash, it's really the key thing right now. They say cash is king, so you've got to make sure that you have the liquidity to sustain the business. So around that, normally you'd want to have very open discussions with your bank, have very open discussion and candid discussions with your suppliers, just to make sure that you're keeping the communication lines open and you're able to look at various scenarios regarding those key suppliers and key relationships with banks. On the second item, which is really around capital raising, I think for capital raising, I'd want to start off by saying, when you're going out to look for capital, the first thing you have to do is be very clear about your business. Have a very good understanding about your business. So anybody who wants to put money into your business will want to understand from you, number one, do you have a grip on what the impact of COVID has been on your business? So you've got to be very clear about what it has been, whether it's on the revenue side, the expense side, the supply chain, what are you doing to make sure you're keeping the business running during this period. So having that grip around the business gives some confidence to anybody that you're going to be discussing with around funding. The other key thing is really now, after showing that you already have that grip, is to be very clear around the scenarios around the business. For example, you could be looking at it and saying, we are under a lockdown. The lockdown will be opened in September. If we open in September, this is what will happen to the business. If we open in December, this is what will happen. So basically having various scenarios of the business, and in those scenarios being very clear around what are the trigger points for each of the scenarios, so that then you're able to explain this to the people you're discussing with about funding. And why this is important is because anybody who wants to put money with that business basically wants to have a clear view about the business, the fundamentals, the scenarios, but also more importantly about where the repayment, if for example it's a bank, where the repayments will come from. And if it's an equity investor, they also want to understand very clearly what nature of return and sustainability of the cash flows of the business will be. The other key thing is just to be very clear also around and be very flexible on the source of funding. Today you may be wanting to go for debt, but realize that debt really, the banks are not very flexible. Then you may decide to go for equity. So you need to be prepared to be flexible in terms of discussion on the source of funding, and as well as on the returns and the structuring. Let me not go too much into detail. Over to you, back to you, Fred.
Okay, thanks for Wambua for those responses. Thomas, I know you also wear a risk management hat as well. So there is a question here around two areas. Number one, for a business owner, what should risk management processes look like, and how do you enhance risk management processes during this COVID-19 period? And second question, also now from an investor looking into businesses, what's the investor risk appetite like? What sense do you have of investor risk appetite during this pandemic, and do we expect to see a recovery? And when do we expect to see the recovery?
Thanks, Fred. In fact, on the first question, which is about the risk management processes, I think it still applies even to private equity firms, investors, and also just to ordinary businesses. I think both Ken and Wambua have spoken about cash. You know, they say cash is fact, profit is a matter of opinion. You know, when you don't have money, you don't have it. You know, you can reflect a very good profit, but you need to be able to have cash. So if I look at that story around cash is fact, I think one of the things that has come out very clearly during this pandemic is that many businesses do not have enough runway for cash. In fact, many businesses would not survive for more than 3 months if their revenues dipped. So maybe just I'm trying to frame what the risk management process would look like by starting at that point of cash. And if you look at some of the drivers, and there could be others of cash, one of them obviously is revenue numbers. Revenue continuing to grow or continuing to come, but most importantly is whether when you sell, you're able to collect the receivables or the debtors, and also how you manage your payables. And the payables is a function of cost. So I think when you generally therefore look at the risk management processes, from an investor point of view, you basically have to ask yourself, what kind of sectors are you in at the moment? And what is the impact of COVID on those sectors? And therefore, what can you do, for example, to minimize the risks that are there? So, for example, if you are in a business where your product is not currently being consumed, like if you are in pub business, where now people are no longer going to the pub to drink. So naturally, it means your revenues have dried out. So you will basically need to ask yourself, what is it that going forward post-COVID you will have to do so that you are still able to sell even when you're a pub? A very simple example that that I look at today is the DJs. There are very many DJs online, and they are making money. Those guys used to actually work in the pub. So for investors, it's to ask yourself, which sectors are you in? What kind of risk appetites should be in those sectors? And therefore, that will determine your investment structure. I think Ken spoke about what he was illustrating, senior debt to equity. So you will then need to look at that spectrum, how do you want to mitigate your risks going forward? And therefore, what risk management processes are going to be there? Now, for business people, there's some of the risks that have come out very clearly. As we know, that risk management is a management tool. One of them, obviously, is liquidity. So businesses, when you come up with your risk management framework and you come up with your risk appetite, liquidity risk will have to be at the top. So when you look at your heat map, which is usually the likelihood and the impact, you need to ask yourself, if there's a high likelihood of us running out of cash within 4 months, what is the impact of that? The other one, obviously, that you also need to look at is the forex risk. I think also Kenneth spoke about that. And you have seen what is happening to the Kenya shilling vis-a-vis the dollar. So that's the other thing that people will need to look at. You obviously will need to look at your strategic risk. Strategic risk has many things that you might be pursuing a particular business model. Like, for example, you have seen with private schools, what has been happening. You might have been pursuing a particular business model where kids have to go to school. But now that we have COVID, a lot of the private schools have moved to online, and they are still able to generate some form of revenue. The other thing that you also could look at is the interest rate risk. So far, obviously, the banks have not increased the interest rates. But if you look at it, even in a market where the interest rates go up because of inflation and the other things that come with it, then you'll be impacted. So the long and short of it is that businesses will need to ask themselves, how do they make their risk management processes be robust to withstand several months of reduced revenue numbers, them not being able to collect, and still having fixed costs that they have. So that would be my response to that. On the second question of investor appetite, I think my sense on that will really depend on those industries that are able to withstand the shocks. So if today I was investing in a business, of course, after doing my detailed due diligence, I would most probably go to the same industries that Kenneth was talking about, and that would be medical and not necessarily hospitals, because we've seen the numbers deep. So maybe I would go to medical equipment. I would look at things like technology. I might go to agro-processing, for example. But nonetheless, as we speak, the investor appetite is much lower because, as Ken already mentioned, a lot of the investors are holding back. They are opting to put their money in fixed securities, which will guarantee them some sort of income. And if they invest, they will look at some of those things that Ken talked about, some of the criteria. They look at those businesses that do not have very high capex requirements, those businesses that have clear competitive advantage, and they'll also try to make sure that they go into those businesses which have no high concentration risk. So you will not go into businesses which rely on 2 or 3 customers who might also be affected by the pandemic. So that would be my response to those 2 questions.
Okay, great. Thanks, Thomas. Kenneth, some additional questions coming through. I'll address 2 to you. Number 1 is, how do you determine the forward EV/EBITDA multiple? That's 1. How do you determine the forward EV/EBITDA multiple? And then second, it looks like someone is looking for a conclusion. So are we saying equity financing is not the best option for both sides? I guess for the investor and the investee, are we saying equity financing is not the best option? And in the case of SMEs, what financing instruments should these companies focus on? Is it mezzanine and debt and bank debt? But Edward is also noting that these are being very highly priced, the mezzanine and bank debt, to factor in the risk. So it's not really a good option. So what options are SMEs left with? I think as you ponder on those 2 questions, Wambua, you can also prepare. There is one question from Lennox, and is asking, it seems most businesses were least prepared for an eventuality such as COVID-19. what should be taken into consideration by businesses in case such an eventuality in the future? What should businesses do to cater for such an eventuality in the future? Ken, you can handle 2 questions and Wambua will come in after that.
Okay, thank you very much, Fred. How to determine forward enterprise value to EBITDA? The first thing that you need to do is to determine the enterprise value. And how do you do that? You work out, say, for example, a discounted cash flow valuation of the business. That gives you your enterprise value. Then the way to determine the forward enterprise value to EBITDA is to now agree with the person that is selling the business what they expect the EBITDA to be, say, at the end of 2020. So if you take your enterprise value that you've computed divided by that future end of 2020 EBITDA, gives you the forward EV to EBITDA multiple that you can use. And the good thing about that is that you don't have to fight with the person selling the business. If they think that the business will do well, just ask them, okay, so how much do you think the business will make? And whatever they tell you, say, okay, fine. You have your enterprise value based on your scenarios and your forecasts, and you take that and you divide by the forward EBITDA that they're promising you, and that gives you your multiple. So the second question is, so is equity financing not the best option? No. That's not the point. In fact, if you have, the right risk appetite and you have deep pockets, equity investment, well, and of course, if you know the industry in which you're investing in, equity investment could be very profitable. I mean, we've seen what happens if you invest in equity in a business that is expected to do well. So if we have opportunities in healthcare, opportunities in telecoms and in retail, we probably consider making an equity investment because we understand those businesses, we know where they're heading, and we are happy to take the risk. But what we're talking about here really is how to mitigate the downside risk. You have to protect, your bottom, because if things don't go well, you could end up with minus 38%, as we have seen. So that's why we like to structure this so that it's not just an equity investment, because of the risk of the open-ended downside risk. But with a mezzanine investment, you guarantee your downside, as we've seen here. 15% was the lowest that you could end up with. In bad times, we saw Berkshire Hathaway at 8%, even in when the business is doing very poorly. The last question was, so what should SMEs focus on? Well, you're right. Bank debt can be expensive. Mezzanine financing can be expensive. You need to find a balance on the financing. If you're an SME that's starting out, maybe you might want to look for some more permanent capital like equity, just depending on the capital structure. This is all on a case-by-case basis. But taking a loan from a bank, if you can afford it, yes, that would be a good option. In this environment, I'm not so sure. So if you can get an equity investment today, that would be a win for you. I mean, as long as you're not giving up too much in the way of equity. I think I'll stop there. Back to you, Fred.
Okay, so thank you. So Fred, I'll take the question around what should businesses do to make sure that they're able to survive in the future. So I think the key learning for businesses during this time, I want to look at it from 2 areas. One is financial risk and operational risk. So I think the key thing, just to make sure that that businesses are prepared moving into the future, because for sure what will end up happening is that there will be challenging periods that will come up for the business. So to deal with the financial risk side, I think it's more around the strength of the balance sheet. And the strength of the balance sheet, really, you're looking at your business. And I think there's something every business needs to do is say, there are fixed costs and variable costs. So where a business has very huge, the skew towards between fixed and variable cost is very skewed towards the fixed cost, then it means that whenever you have a shock, like what has happened now, then that the business is going to struggle because you have very huge cash outflows that you need to deal with. So basically what then the business needs to do is make sure that it is flexible enough to move between fixed and variable costs, and especially where the volume of business then comes down. And what that does is, if the business is faced by a challenge, for example, just a significant drop in revenue, then basically it's able to move its fixed cost. On the other hand, then also we have to look at, on the financial risk side, you have to look at the capital structure of the business. So if you look at if you have a business and the business is, say, 80% debt financed and 20% equity financed, then what you end up finding is that you are introducing a very huge fixed cost on the business in the terms of debt repayment, both principal and interest. And if you have a shock on your, in the system, just like the COVID period now, then revenues drop significantly, your liquidity has a problem, then you end up having a problem with meeting your obligations. So the key area around financial risk is just to make sure that your costs, you have a very good mix between fixed and variable. On your capital structure, on the other hand, you also have a very good mix between your debt and your equity. The other side is really around the working capital management. So one area where businesses end up not doing too well is working capital, because you want to increase your sales, you want to do it at despite any cost that comes with it. For example, you want to give a lot of credit, so you're focused more on the sale than on the collection. And a sale is never completed until you collect the cash. So you've got to be really very clear around how you manage how much credit you're giving, collecting that as cash, and on the other hand, also negotiating with your suppliers to make sure that your credit days are reasonable. So I think a rule of thumb should be that your cash cycle, you should be able to collect money. For example, let's take that you bring in raw material or you buy a product, you keep the product in your store for, say, a month, then you sell it in the second month. That means that it's taking you probably about 2 months to convert the product that you brought in to a sale. Then it means that you cannot pay your suppliers in the first month. You've got to negotiate and have that your suppliers are being paid in the third month. So you need a 90-day credit period. That means your customer, you can't give your customer more than a 30-day or 25-day credit period, so that the money from the customer is what pays the supplier. So something that is very important coming out of this period is that I think a lot of SMEs and a lot of businesses also in general will now have to really prioritize their working capital management. The other side, I think a big learning for the future is around operational risk of the business. I think a lot of businesses have business continuity plans, but the first thing you need to do before the business continuity plan is you've got to carry out an enterprise-wide risk assessment on if anything goes wrong, what would happen. So it means that you carry out a risk assessment on your supply chain, on your IT. You've got to carry out a risk assessment on your financials, on your customers, everything basically enterprise-wide, and then come up with a plan on how to address should you have a problem in each of them. And part of that is the business continuity plan. But most of the time when we look at the business continuity plan, we want to almost focus on the ICT side and probably on us getting our supplies coming in. But it should be cover the entire business and then move on from there. So I think those are some key lessons around that we need, that we take as learnings from this period around how we implement work into the business. Thank you, Fred.
Okay, super. Thanks. Thank you, gentlemen. I will also address 2 questions to myself, despite being the moderator. There's one being asked around the derivative instruments. They're a good way to manage risk. And then the other is on commodities and whether one should be looking to hold commodities as a risk management strategy at this time. So on the first one relating to derivative instruments, and quick definition, these are instruments that derive value from other assets, other underlying assets. And indeed, yes, they could be a good risk mitigation tool, and they vary between hedges, swaps, and the like. So look at a business that they have, say, maybe some US dollar obligations. They could enter into a swap where they are able to buy dollars at a future date at a certain price. If you take the view that maybe the dollar is going to cross 120, and you have an opportunity to enter into a derivative where you buy dollars at a future date at 115 shillings, then it mitigates the risk of the dollar going to 120 and above, and you keep your costs low. And it could be the same for any of the other inputs, even agricultural processing. Maybe you get into arrangements where you buy future products at a certain fixed price. So it could be a good risk mitigation strategy. Of course, will all come at a price, the derivative instruments. So it's really a question of weighing whether the price you're paying to is worth the risk that you're looking to mitigate against. As far as holding commodities is concerned, such as gold, is that a good risk management strategy? In some limited circumstances, I would say yes, it is. I was looking at some industry data, and of different industries. Some have of course been very hard hit during this period of COVID. I think the worst hit that I saw from that report was, of course, the airline industry, then followed closely by the oil and gas on the production side. The one industry that was not affected and actually grew in terms of value was the precious metals. So yes, to the question, precious metals may be a good hedge against dilution of value. And indeed, we are seeing a number of options for one to invest in precious metals, either through exchanges or commodity exchanges and the like. So it could be a good risk management strategy. So as I bring this to an end, I think I'll just ask the last question to Thomas Omondi, and it's around people. And the question is, how can people be a solution to the high risk environment that we are currently facing? What responses should we be expecting from staff today?
Oh, thank you very much, Fred. It's an interesting question asked within this topic. And I think for me, the first thing I would say is that one of the biggest contributions for people would be, first of all, for the people themselves to be safe, which means that they need to abide by all the guidelines. You most probably know about the numbers today. The numbers have almost reached the 200s. So the first thing is be safe, which means people have to adhere to the guidelines, because generally, as you know, most companies, not most, all companies require human resources. So that's the first thing. The second thing, which I think people can help in mitigating the challenges that we have or the risks, is being supportive of the initiatives that have been put by the organization. So for example, when you talk about cash management or cost containment, some of that stuff will affect the way people move around. So if, for example, one of the things that the company has decided to do is to remove certain allowances, or the company has decided to remove how much stationery you use, or the company has said now you have to fuel your own car, or the company has decided we are going to use a substitute raw material as opposed to what you're used to. So that's the other thing that staff can contribute to. But also, one of the other things that staff can help to do, or people can help to do, is to be innovative. So it's to look at ways in which this organization can continue to generate revenue. You know, for example, that pubs have been closed, as I said, but some of the beer companies are still able to sell beer. They have, I'm sure staff came up with ideas to put up the various packages on social media, and people are able to still buy beer. There are many organizations that never used to be on digital that have now been digitized, and you can buy their products digital. The other thing that people can help with is to be flexible. So there's an element of flexibility where your organization might ask you, not only to work from home, but also to acquire some of the gadgets that you need to work from home, because they may not have money, as Ken has already told us, they may not have money to buy CapEx items. So they might ask you to buy a computer, for example, so that you can be able to work from home. So Fred, when it comes to people, there's a lot that actually people can do. I mean, I was just talking about a short while ago where the DJs are now online on Facebook. I didn't know until somebody told me they are on they are in a disco online, because there was some DJ of their liking who was playing online, and actually they have an M-Pesa number, so they are able to earn revenue while sitting at home and entertaining their patrons. So those are some of the things that people can help to do. But also, most importantly, is to help to mitigate some of those risks that we talked about, including some of the ones that Wambua has talked about, operational risk, for example. So there's a lot that people can do, but the first thing is to be safe. Thank you.
Great, thank you very much, Thomas, for that. I think we've come to the end of the questions. I'd like to thank each of the panelists for your time and for sharing your thoughts. I'd also like to thank Kenneth for preparing the material, and just to confirm to all participants that we will be sharing the presentation to all the participants who are registered for this. Final thank you to all the participants. We are doing this for you, and we hope that it is beneficial, and we shall continue to hold this on a fortnightly basis, and you're welcome to keep participating with us. The next one, in another fortnight, we will be having our group CEO, James Moria, who is also a partner with us in Centum Capital Partners. He will be presenting on an interesting topic on what do successful businesses, or what will successful businesses look like at the end of this crisis, and how do you develop resilience in the face of uncertainty. So that's what Dr. James Moria will be addressing, and we invite you all to participate with us. So in closing, once again, thank you very much, and we look forward to being with you in the next session. Thank you, and wish you all a good evening.
Thank you.
Thank you.